FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network, and I'm Kerry Lutz. Today is August 7th, 2018. As always, be part of the show. We invite you to connect, and who knows, we might even have you on the show if you write a good enough email. The address is kl@kerrylutz.com. Well, with us now, person's been with us a number of times before. If you consider yourself to be an unconventional investor or an alternate investor, he's somebody you want to hear from. And you find him at wealthformula.com, which is a nice sounding website. And his name is Dr. Buck Joffrey. Buck, welcome back to the show.
Thanks for having me, Kerry.
Hey, so we're in this situation now. Half the world thinks everything's going to collapse tomorrow. The other half thinks it's just going to go on forever, or they don't care because you're doing well now. Why worry about the future? Where do you fall on that spectrum?
Yeah, I kind of stand at the edge of it just like everybody else. I think, the way I think your approach, Kerry, when you talk about, being prepared for anything and as a general rule is a good approach. I think the problem with being overly negative is that a lot of times you lose out on opportunities. And if you see, some of the guys out there who I like and who I respect, guys like Peter Schiff, for example, they have been talking about how the zombie apocalypse is around the corner for the last 6 or 7 years. Right now, if we all listen to that, the problem is in the last 6 or 7 years, people have made an awful lot of money, right? And so you might be kind of feeling bad about yourself. And if you look at Ray Dalio from BlackRock, who's on a CNBC show a couple months ago, I think it was like 2 months ago, and he's also, even though he's a relatively mainstream guy, has been talking about the coming winter. And then after the Trump tax cuts came, his take was, listen, if you right now sit on the sidelines for the next couple of years, you might feel, sort of foolish. On the other hand, because the way the whole thing is, set to, with all the debt, with all the leverage, with the second longest expansion in GDP, what goes up must come down at some point. So how do you prepare for that? That's real question. And I think the answer, to me, there's not a clear answer, but what I'll tell you is, for me, what I'm trying to do is invest. I'm going to continue to invest because investing still is better than not investing, because not investing is a guarantee to lose money if you're putting money in the bank and letting it sit there do nothing. Mm-hmm. But I think looking at things, in each asset class and determining, what makes sense, how to approach it. Now, for me, real estate is a big part of what I'm interested in. And I have an investor group, and we go after larger assets typically. So it's not 2009 or 10 or 11 anymore where you can buy anything and look like a genius 5 years later. So how do you do it?
Good question.
So my take is this. Is first and foremost, now's not the time to go into the secondary and tertiary markets, right? Because usually what happens is that people, when they feel like the yield tightens up too much in the major markets, the Dallas, now I would say Phoenix is in this too. And some of these really good markets, they start to go into Oklahoma City or whatever. And those are the ones they're going to get creamed, right? They're going to get creamed because the reality is that no one, when times, are tough, people go back to the primary markets because things are on sale and the secondary markets get killed. And those are not necessarily the greatest assets. So sticking to good areas, sticking to really good assets, right? Now's not the time to buy horrible assets just because you get a little bit extra yield. Now's the time to make sure you're still picking up quality assets that even if the markets turn, people will want them again, at some point, even if you have to hold on to it a year or two longer than you might have. The second thing is to only buy things where you actually can create value in terms of real estate. Now, what that means is value add opportunities. So what I would tell you is that in 2008, people who invested and lost major properties usually didn't do so. And I'm talking about like apartment buildings, et cetera, not, home flipping in Miami. Mm-hmm. But the people who lost buildings, people were losing buildings even though they were coming out with positive cash flow. Now that's crazy, right? Robert Kiyosaki was telling me about a building he had in Phoenix that he was cash flowing like, several $1,000s a month. And the bank called him and said, hey, they basically gave him a capital call. And they were like, you need to put more money into this property. He's like, why? I'm cash flowing like thousands of dollars a month. And they said, well, we did the appraisal and you're violating your loan to value covenant. In other words, leverage, right? If you've got 70% or 80% loan to value, that's what your loan covenant is. That's what your bank is saying they're going to lend you. Now, whether or not you're cash flowing or not, in the larger assets, they're going to come and appraise that property every 12 to 18 months. And even if you're making a lot of money, they're going to say it's not worth as much as it was before. And hey, by the way, you have too much leverage on this property, and now you owe us a bunch of money. So don't over leverage. Try to stick to relatively moderate leverage and at the same time create value in a property. So the confluence of those things is very likely to keep you in a safer position because you are starting with relatively moderate leverage. Maybe it's 70%. I think that's relatively moderate. If the covenant is 80%, you take 70%, and then you continue to drive up net operating income with value add, and that will, in my opinion, more likely keep you safer than the alternative, which is to just buy something as if it was 2012 and just rely on dumb luck.
Mm-hmm. Yeah. So you want a case where you can get some forced appreciation too, right?
Exactly. That's forced equity, right? You want to drive up. And that's what my investor groups, what we're typically looking for, in syndications is things that we can get where we can, which aren't managed very well, where we can drive up the rents, where we can, put in washer dryers and, you get a couple hundred units. And again, remember, my investors are not, buying this all on their own. They're in there for, $50,000 at a time or whatever, but they are leveraging this whole idea through a third party, through the operator of just driving the value of a property up. Understood. And the more income that property creates, the more it's worth.
Yeah. I totally got you there. It makes a lot of sense. So what about these going from a B property or a B plus property to like a C plus property? That's something investors also do when prices get bid up high like they are now. Yeah. Dangerous, right?
That's the problem, right? It's like those C plus properties right now. If you talk in terms of real estate, in Dallas, for example, where there's a lot of these investor groups with a lot of relatively amateur asset managers who are bidding up really lousy, C class properties, cap rates of 5, and historically they've been around 7. I think the challenge again there is those are not going to be quality assets. Now, they may get lucky because it's Dallas, and Dallas seems to be bulletproof sometimes, but you just don't know how long. I think sticking to a plan, okay, I may buy a property, I may pay a little bit more for it up front, but I have room for it to make it a more valuable property by putting the work in is a better approach than necessarily looking at a worse property. I'll tell you in my group, one of the strategies that we're doing successfully with some operators is we're buying properties that are what we would call sub-institutional assets, right? So a syndication group comes in, we come in and we help to take down a $20 million building. And again, remember, this is these individual investors that are like 6-figure people. They're all putting in 25, 50 at a time. It's not no one's putting in $1 million or something, right? But we'll take a property that maybe it's like a B-, that something that the institutional players would never look at. Mm-hmm. And then we're creating a ton of value, making them really nice, or turning a Motel 6 into like a higher level Hilton that you don't have to do much to. And the institutions then love it. But here's the beauty of it. So you're taking a sub-institutional asset, which, you're not paying a premium for, and then you're making it nice enough so that the institutional buyer wants to buy it. And as you and I know, institutional buyers, well, they don't need much yield, right? They're willing to pay a premium if they don't have to do anything.
Yeah, exactly.
Work's done. So it's been a great strategy for us. So.
Yeah, that makes a lot of sense. So tell us about one of these projects. You don't have to name names or whatever, but just give us an example of how this has worked for you.
Yeah. So, so if you look at property in Phoenix, Arizona, $10 million of equity raised, again, through individuals investing $25,000, $50,000, $100,000 at a time. These are all accredited investors, of course, from my group. The operator is really, really good that I work with. I won't, again, talk about anything specific here. We take a project that, and basically after 3 years, everybody in the deal, because of refinancing, because of so much equity was forced into the deal. We added, washer dryers. We maximized rents. Put some nice parks and things like that on the property so that it attracted a higher group of people. Within 36 months, everybody got their money back because so much equity was forced in the property that there was a cash out refi. So everybody still had ownership in the property, but now they had their initial capital out of the deal. And then 6 months later, the property was sold to an institutional buyer. And so just under 4 years, everybody ended up with an annualized return of about 35%.
Which pretty darn good with not a heck of a lot of risk.
Yep. So that's kind of, that's what we like. And by the way, this property we're talking about something that was, just done. And this is like 3 years ago. It's not like the market was cold 3 years ago either. No. I mean, it's 2018, 15. We were still at a hot market. So this is we're still riding high in the cycle. And we force so much equity into these properties that if we can't refi, well, darn, we're just going to cash flow a bunch. Mm-hmm. Right. So,
yeah, it makes a lot of sense and sounds like good deals, but it really is beginning to feel like we are at the end of the cycle, isn't it?
I think so. I think that's right. And I think, again, it's like unless you have a strategy of creating value, it's going to be hard to buy anything that's really worth buying right now.
Yeah. So do you step back and wait, or do you look for these value add deals? How do you find a value add deal?
Most of the value add deals are, so the operators that we work with are incredibly experienced. I mean, one we work with the second largest, operator in Phoenix, and most of this is off market, right? Most of this is, brokers or even just word of mouth. Mom and pops have held onto a building for 25 years, and they're just riding at 100% occupancy. They haven't updated anything since 1985.
Yeah.
And because in those situations, they sometimes the brokers just look for people who bought a lot of property in the area. So that's how you find it. Mm-hmm. I'll tell you, it's Terry. I don't buy individual apartment buildings anymore. The ones I have, I'm selling right now because I just feel like it's a good time to sell as an individual, especially if you bought it at a good time. I think that in order to do the kind of value add that I'm talking about, it really requires a real professional group and people who are doing this full time. So what I'm doing is really just finding those groups and attaching myself to them. That's what I'm good at, and I'm not going to be the one who's pounding the pavement every day and, going out there and painting things and, putting in a washer dryer. So,
yeah, well, of course. So, so the value adds, they're around, but they're a lot harder to find than they were a few years ago, obviously.
Yeah. I think they're around. I think it's a value game. You just have to, there's always mismanaged properties. And so, how are you going to find them as an individual? I think it's tough. I think if you've got a group that's going to go in there and do some massive value add, I think you still have some opportunity. I also think, though, that, every market's a little bit different. Now, everybody talks about how real estate in particular is all local. Yeah. And so, there's still people out there who in their neighborhoods are finding good deals. And if they know their neighborhood and their individual buyers, and go ahead and do it. One of the advantages to right now in buying smaller assets is that if they cash flow today, they'll probably you're probably fine, because those larger properties that I'm talking about, like that have non-recourse debt, Fannie Mae debt, those are the ones that have they do the automatic appraisal every 18 months or 12 months.
Right.
Usually in these smaller, if you got single family homes, you got duplex, you got fourplex, even 15, 20 units, you're probably going to be working with a small bank that's not even going to bother doing an appraisal. So if you're cash flowing now, you're probably just going to be fine. So.
Right. So make sure you're cash flowing for sure. And are there certain states, jurisdictions you just don't invest in now?
Well, yeah. I don't. I've never really been one for New York. New York, or I live in California because I love the weather, I love the lifestyle.
But don't invest there, right?
I won't invest here, no way. The ones that personally I am a big fan of: Arizona. I love Texas. Florida's good. I think Atlanta. Those are good markets. I used to. Everything I had in Chicago, I'm selling right now, and I'm selling because taxes are going up, and it's becoming more and more bureaucratically challenging for landlords. There's plenty of places. Texas is so big, you can just focus on Texas all day long.
There's so many markets there in Texas.
Yeah, exactly.
There's even going outside of Dallas, Fort Worth. Yeah, that is a distinct separate market from Dallas.
Yeah, and I like Fort Worth. I think not the first ones to discover that, obviously. Austin is great. It's been sort of done too. I think I like San Antonio. I think San Antonio is a great market, and I think the proximity to Austin really makes that still very good.
So a lot of markets still out there, and if you're looking to buy in a market that hasn't appreciated yet, all right, that has had minimal appreciation, 2-3% a year, probably your risk is a lot less, isn't it?
Yes and no. Listen, I think it depends on what kind of buyer you are, because usually those markets that don't, I remember literally 6 months ago, or maybe it was 6 to 8 months ago, somebody was telling me I had to look at Oklahoma City. And they had this, everybody was trying to get excited about Oklahoma City. The people I know ended up buying in the last 6 to 8 months are not doing particularly well. You got to have market drivers, right? And if you have market drivers, you're going to tend to have appreciation. The ideal situation is you get there before everybody else catches on that it's a good play. But I think, most mom and pops don't necessarily have all that information.
Yeah.
To know where the puck's going, so to speak. So, for example, I think a really interesting market that we just did a property in was Mesa, Arizona, and the reason is it's between Phoenix and Scottsdale, and there's a ton of So occupancy is like average occupancy in apartment buildings. There's like 96, 97%.
Right.
There's a ton of people leaving the state of California because of, cost of living, taxes, et cetera. And they are going, they're going to that metropolitan area. So those types of demographic shifts, I think, are things to look at, because they don't necessarily, change that dramatically, in a downturn. And I don't know about you, but, I think that the next recession doesn't necessarily have to be a, explosive event. It could be one of these things where there's a downturn, and who knows, maybe we're already, and we just, you always hear about the, recessions, and it used to be Carrie, that you'd hear that we were in a recession about 2 months after we were in a recession.
Right. Right. Yeah, that's always the case, because all of them are lagging indicators. Right. It's always going to be the case. So hey, it's interesting, and sounds like there's still opportunities. You just have to be in with savvy players who understand what creates value and not to overpay too much for the potential value. Hey, people want to find out more again about you, Buck, want to connect with you. Where's the best place to go?
Well, I have a podcast, Wealth Formula podcast, and it generally caters to people like me. Well, I used to be I'm still a physician. I don't practice, but people who are sort of, higher paid professionals who are interested in learning about this alternative type of investing and actually getting involved. And then they could also download my book if they want at wealthformula.com. 7 Secrets of Eternal Wealth was an Amazon #1 bestseller. And then you could also just text me at 44222 and type in Wealth Formula, one word, and you can get that book as well. So, lots of ways to get it. All right. In touch and follow me.
And we will have a link to your website in the show notes to this interview. As always, financialsurvivalnetwork.com. Make sure you sign up for our newsletter. We got a free webinar coming up this Wednesday at 9 p.m. Eastern Time, 6 p.m. Pacific Time, dealing with different types of investment, cryptos, and mining companies, precious metals. So just send me an email if you want to join us. Otherwise, you'll find it on the site, financialsurvivalnetwork.com. Email address again, kl@kerrylutz.com. Twitter feed is @KerryLutz, and Facebook page is Financial Survival Network. Buck, really appreciate you coming on. Always a pleasure. We'll talk to you again soon.
Thanks for having me, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.